This episode is brought to you by Sorare. Stay tuned for more information on them later in the episode. What's up, everybody? I'm Scott Melker, and this is the Wolf of Wall Street's podcast, where twice a week I talk to your favorite personalities from the worlds of Bitcoin, finance, trading, art, music, sports, and politics. Basically, anyone with a good story to tell. Now, institutions are clearly becoming increasingly interested in digital assets, but there are some institutions that have been trailblazers in the space for years. Arguably, none have been beating the drum harder for crypto than Fidelity, a behemoth in investment management with over $4 trillion in assets under management. Wow. Today's guest, Jurrien Timmer, is the director of global macro at Fidelity. I've preached often that the path to generational wealth is patient and informed investing. Well, Jurrien's a master at curating these strategies and a proponent for including cryptocurrencies in investor portfolios. So thank you so much for coming on the show. It's a pleasure to have you.
It's great to be here, Scott.
So now to get into today's episode, can you talk a bit about how Fidelity first began exploring crypto?
Yeah, so we started, I'm not exactly sure what year, but it was at least 5-6 years ago. I think that the general thinking was, nobody really knew what it was going to be at that point, but we knew that as, one of the world's largest financial institutions, obviously, if it was going to be a thing, we needed to be there, and so we started getting involved. We even mine our own Bitcoin, very sustainably, I might add, using hydropower. But so we were really a very early mover, certainly from the lens of a traditional financial company, as opposed to a bunch of coders out there trying to get involved. So I don't know if we were the first, as in terms of large institutional players, but we should have been one of the first, I think.
Not shadowy super coders, I guess.
No,
as they like to call us, right?
Exactly.
But that speaks, I think, to certainly the ethos of Fidelity as a company, because everybody heard about it 5 or 6 years ago, but very few decided to do anything and were utterly dismissive, to be quite honest. I don't think they even foresaw that it could become a thing, much less that they would actually put resources behind the chance that it might become a thing. So what is that about Fidelity that as a company you would be interested in even exploring a new asset class?
I think it's just the way that the industry and Fidelity has evolved. I mean, when I started there in 1995, very, very long time ago, and at that point, the mid 90s, it was the holy grail of active management, and we were really just a mutual fund investment organization, building a lot of skill. I mean, we already had a lot of skill, but as that industry matured and as it became more passive, with ETFs kind of taking over the landscape, and as Fidelity created even more scale as just a general financial services organization, beyond just managing money, but also taking care of people's money, even if it wasn't at Fidelity. I think we have 11 trillion under administration, and I think we have something like 38 million customers, right? So the scale is pretty off the charts. But the operating structure evolves. So we became really more of a technology company in a way. I mean, we're still obviously a mutual fund. We still have, as you said, 4.3 trillion under direct management, but the needs change, and it's all about scale and technology and making the experience easier for people. And I think, blockchain was recognized as being potentially a disruptor. Nobody knew if it was going to be a disruptor, but we weren't really talking about DeFi back then, of course. But the potential was there to be a technological disruptor, and we tend to get there early when we see something moving.
Right. And if crypto becomes that big, most companies of your size will probably be the blockbuster and not the Netflix. Right. Yeah. And I think it takes some vision to appreciate that that's even a possibility. So you mentioned, obviously, Fidelity's early interest in ETFs as well, and becoming a large player in that industry. The Bitcoin ETF, Bitcoin futures ETF, whichever it may be or not be, has been the talk of the crypto town, certainly for quite a while here. And it was reported that Fidelity was in private meetings with regulators trying to push for an ETF. So why do you think an ETF is important? And do you think that it's likely?
Yeah, so I was not in any meeting, so I just wanted to put that to make that clear. But it's an ETF, whether it's us or someone else, and depending on what the bones are, whether it's futures or some kind of storage. And Fidelity already has a product for non for accredited investors. I mean, it's likely to happen. I think I don't know if we'll be the first or when it will happen. It may take longer than maybe most people think, just because obviously we know what's happening on the regulatory front or what's not happening on the regulatory front, but that all eyes are on the industry. And I think I would imagine that as the industry becomes more mainstream, there will be more regulation, and we generally see that actually as a good thing because it
Of course.
will basically legitimize the space. And I think when I talk to institutions, for instance, corporate treasurers or pension funds CIOs, I think there's always a list of things that people worry about. One was sort of the ESG angle, which I think has largely subsided now that China has banned mining. But one is obviously regulatory risk, volatility is the other one, and I think if the space does get regulated, obviously in a constructive way,
Yeah.
I think it will actually help legitimize the industry and will facilitate the institutional adoption. Like the retail adoption would require some vehicles like an ETF, for instance, but institutions don't generally need that. So there's still a bunch of things between here and there, and whether it takes 6 months or a year or 2 years, I don't know, and I don't think anyone else really does either.
You said quite a few things, and the one that just stuck immediately into my mind was that you're having conversations with pensions about Bitcoin and crypto assets, right? Because a few years ago, that would have been unimaginable almost. I think I've made the argument that your average risk manager or portfolio manager at a company probably would have been viewed as crazy 2 years ago if they even dared bring up Bitcoin in a meeting. And now it's probably flipped. You have to have some knowledge of it, or you're the guy who's behind the times. So are you seeing that across the board with the big wall of money, endowments, pensions, these people that you're talking to, when we talk about trillions coming into the space? Is that really a part of the conversation?
It has been, yes. So I went down the rabbit hole on Bitcoin specifically last December. Like it's like any of us, right? You're a bystander until it starts to saturate the airwaves enough that you're like, okay, I'm going to learn about this. And first thing you do is you go on Twitter, and you quickly realize that there's a lot of very polarizing opinions, and they're not always that well backed or that objective, if you will. And I think institutions had probably that same issue. Again, we're talking about 6-9 months ago. It's a hard thing to understand, to onboard yourself with. There's a steep learning curve, and so you have to put in the time to understand it. And I think especially when I wrote this paper back in February about Bitcoin being, an aspiring store of value and kind of digital gold and what it would mean in a 60-40 portfolio in today's world, where that 40 side of the 60-40 is a little impaired through negative real rates and et cetera. Yes. And so that was kind of my conclusion that, I don't really want to touch the 60 side, because the equity side is a pretty proven store of value with its compounding, math behind it, even during inflationary times, not hyperinflation, but regular inflationary times. But the 40 side, normally you get paid to diversify against the 60, right? You buy bonds, you get income and diversification. These days, you have to pay to get the diversification because you're paying through negative real rates. You're still getting the negative correlation, but you have to pay for it. And so that was my conclusion. And I think that generally resonated with institutions. So we went through a few months where we sat down with a lot of CIOs, mostly of corporate pension plans, but also some treasurers. And I think for them, it was really like, how do I learn about this space? Maybe they had a board member knocking on that door saying, what's this Bitcoin stuff about? Or maybe it went in the other direction. And there weren't a lot of places to go. Since that time, most financial institutions, the large ones, have weighed in on the matter, but we were kind of one of the first ones. And so for them, it was really just kicking the tires. What is this all about? How should I look at this? What do I need to know? Whether they were ready to pull the trigger or not, I wasn't privy to, but there certainly was a lot of interest. And of course, remember, this was also the time when Bitcoin was just roaring ahead to its $65,000 peak so far. So there was that kind of that momentum that I think also forces people to say, God, what am I missing here, right?
Do you think that institutions are generally cognizant of the problems with money printing? I have conversations all of the time with Wall Street guys, even on these, and they sort of view it as a benefit. You talked about the 60% in equities. Obviously, that benefits from inflation to some degree, right? You buy hard assets, they go up in value because of inflation. Or do you think that they believe that you can still hold cash in a treasury or hold bonds and it'll be fine? Or do you think they have a long-term vision that we really need to start investing in some assets that might be a hedge against this?
I think the conversation starts with, um, you know, historically, when you would own gold as an investor, so I don't view gold as something you own all the time, because most of the time it's just sitting there on the far right hand side of the risk reward spectrum. It's collecting dust, and it has an annualized volatility of like 25, and it's essentially earning the inflation rate. That's historically been gold's role. But there are times, regimes, where gold does extremely well, and those are times when monetary inflation is very high. So 1970s, 1940s, even around the financial crisis, and obviously in 2020, excess money supply growth minus GDP growth to something like 35%. I mean, the highest we've ever seen.
Ever.
So that would normally be a time where you want that store of value to protect yourself from inflation and from negative real rates. We all know that gold trades in lockstep with the 10-year TIPS real yield. And so it is a perfect hedge against negative real rates from that sense. But then essentially Bitcoin enters the scene, and it has the potential of being, a digital form of gold, but with more convexity, because it has that whole network dimension, and it has even scarcer supply than gold, right? Gold supply is scarce, but it's scarce at the same rate of change in terms of the amount of supply, in terms of its stock to flow. The same amount of gold is mined more or less every year. And of course, we know the story that for Bitcoin, that is not true. That is not the case. So I think, generally speaking, when I talk to investors, that's how I think about it. And I think that's generally kind of what they take away from it, is that a period of monetary inflation, you need a hedge. Stocks are one of them. And again, in the 60-40 mindset, which I think most of us live in, whether you're institution or individual investor, it really is that 40 side where, certainly on the short-term side, if I'm going to lose, 2, 3, 4, 5% of my money in terms of purchasing power, very similar to what happened during the 1940s, during World War II, and the Fed was kind of, tasked with monetizing the increase in debt, and it capped interest rates at 2.5%. I liken it to a kind of analogous to that period. And of course, gold wasn't free to trade back in the 40s. That happened in the 70s. But once gold came of age and it was free to become an asset class, it was kind of money before, now it became an asset class. It did its thing in the 1970s. And I view Bitcoin as kind of doing that same thing, that coming of age. And so in the conversation we've had, generally that's kind of where I go. And I think that view, I think, is generally shared. Like, I think that resonates with people, with institutions, as to, okay, because, it's easy to say, wow, this is really cool. But then you're operating or managing, an endowment or a pension. Then you have to figure out, like, where does it go? How much do I own? Like, does it go on the 60, on the 40? Is it 1%? Is it 5%? And so there are a lot of open questions, and obviously the volatility, which I do think will come down over time, as will its return. It's the Sharpe ratio will probably stay the same, but both the numerator and denominator will come down. But obviously, being an institution, especially a treasurer, where you are just meant to do no harm, keep that cash safe. Buying something with a vol of 100 is not an easy task, right?
That's true. So you speak to them in a language they understand, basically, and the
Right.
language that everybody understands is gold. But gold hasn't fared particularly well in this period, right? While we've seen Bitcoin, obviously, from the March 20 lows pulled 17x to 65,000, as you talked about, gold remained somewhat stable, which is fine. But do you now view Bitcoin as a better version of gold? Do you think that there's a general sentiment that gold has, no pun intended, lost its luster and that Bitcoin has now become superior? Because really, it seems like there's a pretty sizable exodus from the metals market.
Yeah, I think as Bitcoin comes to into its own being as an aspiring asset class, and one with a very very unique, maybe the most unique ever supply demand dynamic, right? I mean, it has that scarcity. And it has the network. I mean, I don't know of any other asset that combines those two things, right? Gold does not have it. It doesn't have the network effect. It has scarcity, but like I said, its stock to flow is pretty stable at around 50, I think, whereas Bitcoins will just go up over time. And so I do think that Bitcoin has taken market share and mind share from traditional precious metals. And I think as Bitcoin matures over the years, it will become kind of like a pairs trade. Like before Bitcoin, if we were in the precious metals, theme as a market, we could go gold versus silver, gold versus gold miners, right? They're like ratios, and one gets oversold to the other. I think we'll in 5 years it'll be Bitcoin versus gold. It'll be Bitcoin versus Ethereum. I mean, like everything will trade as a pair, and if one goes too far, then people will start gravitating. And one of the things we're not seeing a lot on right now on neither Bitcoin nor gold is actual valuation work, right? Everyone kind of anchors to price, and gold's valuation would be trading off of the real tips yield, for instance. But gold trades off of the 10-year real yield instead of the 5-year real yield, and I could have easily have seen it pick the 5-year. And this may sound like inside baseball, but the 5-year real yield is much more leveraged towards Fed policy, because when the Fed does QE, it's buying in the belly of the curve. And when the Fed sets forward guidance, it goes out maybe 3, 4, 5 years, but not beyond that. So the 5-year tends to be more sensitive to Fed policy. And so if gold was trading on the 5-year real yield, it would be at about 2200, which is not that much higher than where it is, but it's higher. And so gold could have easily been justified to trade at 2200 right now, but it's not. And I think it's because it's just losing mind share, and maybe younger generations of investors who don't have any gold. Maybe they say, well, I've got this gold and I've got this new digital gold. Why don't I just go there? Whereas maybe an older generation who's always been in gold, well, that's like their benchmark, and they'll go there.
I don't think you're ever convincing the younger generation to buy a bar of gold and secure it. I just don't think it's going to happen. And I think the same sort of relationship you just described is the same relationship that older generations tend to have with technology, right? Mm-hmm. So a younger generation is inherently going to adopt something that makes sense to them because they're a more technologically forward generation. So that makes perfect sense. So something that you were talking about before, we talked about the 1940s and 1970s, periods of monetary inflation where stores of value like gold have succeeded or thrived. This, I hate to use the words this time it's different, but it feels like the expansion of monetary policy now is different, that, we're seeing a 30-40% increase in dollars printed of all time in 1 year. So do you think, you talked about gold being a trade for certain times, but do you think that now is the environment moving forward, and that we will continue to see this increased monetary policy, inflation, money printing, and that maybe these assets become a permanent part of your portfolio rather than something that I hate to use the word transitory, but something that you move in and out of depending on the environment?
I think the potential is definitely there for that. And these regimes that I mentioned of monetary inflation, they do tend to last a while. They can last, 10 plus years. And by monetary inflation, I just mean that money supply is growing faster than its historical trend, right? We have M2 going back 100 plus years, and it grows at a certain kind of trend line. And then you have these periods like the 30s, 40s, 70s, late 60s, 70s, around the '08 financial crisis, where it just kind of goes much faster than that. And so that regime can persist for a while. So by regime I don't mean you own it for a year and then you sell it.
Right.
But when I look at the efficient frontier, risk on the horizontal, return on the vertical, and I go back 70 years, and I look at where cash is, it's bottom left, stocks upper right, bonds kind of towards the third, 60/40s right on that curve, but commodities are down and to the right, right? So you're getting inflation, but you're paying like the volatility of EM equities for that, for only getting 3, 4, 5%. But then you have periods 10 plus years where they work extremely well. And I do think the 1940s is very analogous. And I also think what's happening in Japan is very analogous, even though Japan is completely different in many, many, many ways. But I look at the bond market, and I look at what the Bank of Japan has done to the bond market there. The BOJ owns half of the outstanding debt stock in Japan, and it buys half of the new supply. And the Bank of Japan has completely tamed the bond market there into submission. The annualized volatility of long-term JGBs is 3. That same volatility for long-term treasuries is 11. And there are days where the JGB market doesn't even trade. It's just become a thing that the Bank of Japan owns and controls. And now the Fed isn't anywhere close to that. The Fed only owns 26% of the outstanding debt stock, which is only, and it's buying about a third of the new supply. And the Fed can talk about tapering all at once, but my personal sense is that in the coming years, 5 plus years from now, the Fed's going to look a lot more like the BOJ, and maybe it will have tamed the bond market into submission. But the question, we can say, okay, fine. The question is, what is that going to do, right? Will that create hyperinflation, or will that cause the dollar to crash and lose its reserve status? And that, as you know, is a common kind of refrain from the hardcore Bitcoin community. And I don't really share that view. I mean, obviously, again, Japan is totally different in many ways from the US, but demographically, the US is about 10 years behind Japan. When you look at the age dependency curve or the labor force growth rates, we're tracking Japan with a lag of 10 years. And to me, it is not far-fetched to think that maybe in 10 years, our interest rate system will look like Japan's, where the Fed will be the controlling owner. It will have been, there won't be a lot of volatility left. The bond market, the bond vigilantes will be a thing of the past. But in Japan, there doesn't seem to have been a price to be paid for it. They don't have inflation. The currency is stable. And I think this speaks to one of the things that I think is often overlooked when people talk about the reserve status of the dollar and what's going to happen. We're going to print our way into oblivion. And that is that the whole world has the same problem, right? Europe, Japan, China, the US, they all have the same problem. Our collective debt to GDP, so including corporate, financial, individual, and government, we're running at about 300% of GDP. Well, so is Europe, so is China. And Japan takes the prize. They're at over 400% of GDP. But their rates are zero, their inflation is zero, their currency is stable. And so, I don't want to conclude that this money printing era or this monetary inflation era is so self-destructive that the whole thing is going to end in a disaster. And even during the 1940s, right, a different era. We had a baby boom. It was a world war, all that stuff. So completely different environment. But the government tripled its debt when it entered World War II in 1942. The Fed, which was not independent yet, was tasked with monetizing that debt. The Fed increased its balance sheet by 10x. 10x. Okay, we've only done 2x so far. From last year to now. It capped long rates at 2.5. It capped short rates at 3/8. It kept the policy rate, back then the discount rate, at about 1.5%, even though inflation was running at 6 through that period of the 1940s. And when it ended, when the Fed got its independence in 1951, it's not like everything blew up. Bond yields were stable, inflation was stable for a decade and a half until the late 60s, right, with the guns and butter. So I don't want to overconclude that this is so unsustainable that we need to go barter stuff and sell all of our financial assets. So
I certainly wasn't implying. I
yeah.
also don't believe that there's an impending explosion necessarily. It was just more a statement of once the train is going, it's hard to stop, and so I don't think money printing necessarily itself will stop. And with that in mind, the argument that you just made that maybe it'll be fine, probably actually, I should say, it'll be fine, and eventually it will come under control. Has Bitcoin benefited from only existing in a period like that? Obviously, Bitcoin, Satoshi Nakamoto even said that it was, a reaction to the banks and policy in 2008 and 2009 that sparked the creation of Bitcoin. And we've never really been in an environment with Bitcoin where there wasn't, inflationary monetary policy. So is that in some way an indictment or something that we should be, that we should be wary of or aware of moving forward, that if things calm down, maybe Bitcoin won't be the trade at that point or the best investment?
I think Bitcoin's only one piece of the puzzle, right? I mean, Bitcoin is just the incentive token to build the blockchain, right? I mean, that is why people are verifying transactions, and that's how the network grows. And similar to other networks, and you think about Apple or Google, a number of years ago, you grow that network, and it gets to a point where it becomes impenetrable. It's so big. You can't hack it. You can't even really regulate it. Maybe you can try to, but you can't really shut it down anymore. And so I think Bitcoin will in all likelihood benefit from that first mover advantage. And now it's over 10 years old, and there's 38 million addresses with a non-zero balance. It's growing exponentially, and so it goes through these boom bust periods, right? Because it has price inelasticity, right? Because we know the supply. It's not like there can be a supply response if demand goes up, because it's completely set in stone, right? So the price movements is really all about demand. Demand goes up, it moves very, very quickly. And if it goes down,
demand even remains static, in theory, price goes up. Right.
Exactly. So I mean, not to say that the stock to flow model is the best way of looking at this, but you see the stock to flow model, it has these boom bust cycles, right? And they're around the halvings, and I understand why that is. And so where we land in the next year or two, who knows? But I think Bitcoin will have its moments, like it's had since the COVID lockdown, and then it will just kind of sit around and do nothing for a while, and then it will have its moment again. And I think during the periods where it sits around, then people will kind of go back to maybe gold. They say, "Oh wow, gold's really been left for dead here." Maybe there'll be that kind of relative value play. So it has its moments where these catalysts come up and say, "Holy cow, it's now." And then there will be other times where it kind of sits around. And in a way, since April, it's been kind of sitting around.
Oh, sure. Do you love sports collectibles or fantasy sports as much as I do? Sorare is blending this together to create an entirely new gaming experience powered by its community. Sorare cards are officially licensed NFTs from over 160 clubs, including Real Madrid, Paris Saint-Germain, and Liverpool, and all built on Ethereum. You truly own your collectibles. They are productive gaming assets that will generate rewards if you're a good fantasy player like me. Join Sorare and connect with your favorite teams, live the game with passion, and earn weekly prizes. You can do all of this at thewolfofallstreets.link/Sorare. Yeah, and that still implies, though, if you zoom out far enough, that it'll be up and to the right. And so, that does put much higher prices in play. It just might require patience, and it might not be the single highest appreciating asset always, right?
Yeah, well, and it's interesting because so as I did my dive down the rabbit hole late last year, I looked up the Plan B stuff and I tried to like reverse engineer the stock to flow model, which I think I did. But I was left unsatisfied that this can't just be a supply story because something that has no worth doesn't matter how scarce it is, right? And
Right,
so then
of
I started
course.
looking at the Metcalf law stuff, the S curves, plenty of examples of those throughout time, of course. And I built out a demand model, and I actually modeled it after uh, mobile phone adoption back a few decades ago. And when I posted on Twitter, people were criticizing me for how can you possibly compare Bitcoin to mobile phones? It's like, well, that's not the point. It's the network curve, right? That exponential growth curve. That's the point because all those curves are the same essentially. And it's interesting that the demand model and the supply model, have obviously done a good job explaining price so far. And part of that is just because you curve fit it for that period, so it's always going to look good. But they kind of deviate from each other going forward, where the demand model is much more conservative, still with very crazy prices, but less crazy than the stock to flow model. And 2024 is about the last time that those two models intersect, and then they kind of diverge from each other.
You've made the point a few times. It's just worth highlighting. It really is such a unique asset. That's why people don't, I think, understand it. People can understand the supply and demand very easily, and people can look at technology, like you said, Google's, the Facebooks, the Apples, the cell phone, and understand Metcalfe's law and network effects, but they have a very hard time marrying the two of those.
Yeah, yeah. No, and it requires, it's a highly risky proposition in the early days because a small network, can just kind of die off, but a larger network, it builds on itself. But it requires some sort of social agreement, if you will. It's like, money only is money because everyone agrees that it's money. And HTTP/IP in the early internet days, as it gets the scale, then things are built on it. Same with Ethereum right now, where things are being built on top of it. But you need to get to that point, and until you get to that point, like nobody has any idea whether it's going to work or not. And I did a little study that we're posting on Twitter probably in the next couple of days, where I compare Bitcoin to the early days for Apple. I'm not a stock picker, so I don't know Apple, as a security person, but Apple from 1996 on, its price far outstripped its sales, or its market value grew much faster than its revenues did. And that's because as the revenue becomes more scalable, that's my way of describing it as a network. It's not that price just moves in line with that, but it moves exponentially, which is Metcalfe's law, right? It's the exponential. So the sales went up, price went up, or market value went up even more. Its price to sales went up. And so it is not a linear thing. And I think that's what's happening to Bitcoin, is that obviously its network is growing, but its value is growing even more, because the bigger that network becomes, the more powerful and scalable, well, maybe not scalable for Bitcoin because it's decentralized, but you know what I mean, the more immutable
Yeah.
that network becomes.
I mean, in the last 30 years, how many times have we seen, well, either old school investors or people who are used to doing valuations in a certain way laugh at tech? How is this company worth X amount when they're losing X amount every single year, right? Companies that aren't making money have these tremendous values based on that network effect.
Yeah. Yeah. And so, one simple exercise that I did was I created like a PE ratio for Bitcoin, price per millions of addresses with a non-zero balance. So it's like a price to network ratio. And if I index that price to network ratio back to Bitcoin's price in 2010, so Bitcoin's at 40, when I did this, it was 47,000. Bitcoin's price would be only 66 if you priced it in valuation terms. So in other words, most of its price increase was justified by the increase in its network.
Sure.
And so I see very little work on valuation. I think it's important to do it because people anchor to price. It's like 50,000. It was like 2 cents, like, but the network has grown, exponentially. So on a price to network basis, it's not nearly as expensive as it is in price terms. And
Right.
price is kind of meaningless. It's what are you paying for something? It's like Dow 30,000. Who cares? Like, what's the price to earnings ratio? That's
Yeah.
what matters.
I talk about price being different than value all the time. And you made such an important point because that exact argument is a huge argument against Bitcoin and similar assets. I don't know what's the fundamental value of it? It has no fundamental value. It's just price. But there are ways to give a valuation. They're just not the classic ways that Wall Street or managers are used to looking at.
Yep, exactly.
Yeah, that makes so much sense. You said something interesting. You said, listen, money is just a social agreement between people. We all agree that it has value. You can say that it's backed by government or military. Everybody has their sort of idea. One of the largest criticisms against Bitcoin is that it has no intrinsic value. But to that end, what does have intrinsic value? Isn't everything to some degree a social construct or a social agreement?
Yeah, in a way, even language. Like, what if we couldn't agree on what the
Right.
right words are in the English language? We wouldn't get anything done. So yes, I mean, social agreement is a big part of it. And again, think back to the early internet. The actual protocols. With Bitcoin, you can actually own the protocol. In the internet days, you'd have to buy a company that built something on the protocol. Like whatever it's Google or Amazon or Facebook, and so yeah, it's part of it is a social agreement on what this network is and what can be done off of it. And it's still unclear exactly where this will go, whether DeFi will replace, or intermediate banks, or whether they will just live side by side, and just like the post office lives next to the email. And so I don't think it's an either or thing, which again is another kind of maxi way of looking at it. But I think there are a lot of people in the world who live in a regime where they don't know if their money is going to get inflated away or confiscated, or people that are unbanked. By my count, when I look at the World Bank data, there's about 1.5 billion people over the age of 15 who do not have financial services available to them. And so, we're living in a world where, we operate in dollars. We're living in the US. And so we kind of have the luxury of having a stable currency. I mean, the dollar is very stable. Over the past 50 years, in real terms, it's lost 0.5% per year on a compounded basis. Not a big deal. But not everyone is so fortunate, right? So we have the reserve currency. It's backed, like you said, by the largest economy and military power in the world. But there are a lot of people who don't have that luxury. And I think the blockchain and Bitcoin and the whole crypto sphere certainly has a use case for them, as well as for all of us, especially when you think about all the applications that can be built off of on top of this blockchain. But in the early days, it's super risky because you haven't built that consensus yet, right? You haven't agreed on the language yet, or what the value is of money and how fungible it is and how exchangeable it is. But the further we go, and the longer it survives all these big ups and downs, I think the more it will become obvious that this is a new social norm that has a lot of computing power and a lot of stuff that can be built on it.
So you're obviously a fan of the 60/40 model. We've clarified that. I want to talk a bit about individual investment strategy. So I had Mark Yusko on the podcast from Morgan Creek, and he said that, I don't know if it was a study or somebody told him, but that the best performing accounts at Fidelity were the ones where people were deceased and the accounts had just basically never been closed or managed, lending to the idea that passive investment is obviously the best strategy, and that if you actively invest, you're probably not going to beat a dead person. Is that true, and is that a core value of the way that an individual should approach investment?
I just to clarify, but when I think about passive investment, I'm not I want to make sure we're talking about the same thing. But
Sure.
there's active versus passive in terms of do I buy an ETF or an actively managed fund?
Sure.
And I don't think that's what you're talking about. I think what you're
Nah,
talking about is do I
dollar
try to
cost averaging and not
yeah,
trading it away.
exactly.
Just as a very
Yeah,
fixed strategy over a
yeah.
long period of
So
time, right?
so
Not
so
right.
yeah. So in my view, and I've been doing this, 3 decades, is that is absolutely the case. So dollar cost averaging. Don't try to outsmart the markets by trying to time these market cycles. I used to do that. My ego couldn't resist to try to be the contrarian that outsmarts all the other people. And I think it's a fool's errand. I think whenever you try to outsmart the market by getting out, it seems so easy. Like what do I have to lose? I just get out, and then I can just kind of take a look, and I can always get back in. But unless you time it correctly, when you're out of the market, you're not compounding those returns, right? So this is all about the compounding magic of how you get to a 10, 11% return over the long term, even though you have an annualized volatility of 15, which is generally the vol for equities. For a 60/40, it's 9. And that time out of the market can be very costly. And if you're wrong, and you miss the bottom, and all of a sudden the market's back at a new high. I mean, look at how quickly that happened last year. Then it's like, well, I'll wait for the pullback.
The next
Like
tip.
these
Buy the
mental
next tip.
gymnastics. And next thing you know, you've been out of the market for 5 years. It's 5 times where it was before, and you've lost that extremely valuable compounding. And so my take is, and when I talk to my kid, my daughter's 24, she has her 403b account, she's a nurse. I said, just put as much as you can away, don't touch it. You have 40 years till retirement. You're going to do well over that period of time. So I totally agree that the less you have the right plan that makes sense, where you are optimizing return per unit of risk, right? And obviously, the younger you are, the more risk you can take, which means that your 60/40 is going to be more like a 90/10 or something like that. And so set up that plan and just execute on it. Don't try to second guess it. I mean, it's behavioral finance, right? The market only goes up 60% of the time, which means that 40% of the time it's going against us. And that 40% of the time we're going to want to get out. And we have to resist and overcome that urge, that fight or flight urge to get out, and then to rebalance, of course, right? In February of last year, before the big 35% decline, if we had a 60/40 portfolio, literally a month later, it was a 50/50 because stocks went down and bonds went up. Well, you need to rebalance back to 60/40 so that when the recovery happens, the recovery is happening on the 60, not on the 50, right? And so there's really those three rules. Have a plan, stick with the plan, and rebalance either a certain time of year or when there's been a big move. Like after a big move, it's good to rebalance. And if you can do that and stick with it, I think that the market math shows that over time that's been a good strategy. And especially dollar cost averaging, whether it's for stocks or for Bitcoin, you're never going to buy the low, but you're never going to buy the high, and there's something to be said for that.
Yeah. You talked about the potential of having a 90/10 when you're younger, which obviously lends to rebalancing and becoming more conservative with time. What is, and I guess it depends on your age, but what is Bitcoin's role in that portfolio? I know obviously that you've said it fits into that 40 and not into the 60, obviously, because equities do so well. But I guess, do you have a lot to lose if you're 20 and 90% of your portfolio is in, not necessarily crypto, but
I think one of the things that I learned, kind of doing some stress testing on Bitcoin's very short 10-year history, is that a little goes a long way, right? So if the 40 side of your portfolio, or let's say you're a corporate treasurer and you tend to be more conservatively invested, your benchmark's going to be shorter bonds than a general 40 would be. And you're just trying to solve for not losing purchasing power in a world of negative real rates. You don't need to own a lot, assuming that past performance, continues, which of course it won't. It'll be more truncated, I think. But, even like just like 1 or 2% would have gotten you there in terms of flipping that negative purchasing power to a positive one. But, as we talked about, it comes at a cost in terms of volatility. Bitcoin is not a short-term asset. So that's why for like a treasurer, it's really hard because you have a short-term portfolio that you're hedging, for lack of a better word, with a very long-term asset. And then you run the risk of a duration mismatch. So, right, if you're a treasurer and you need that money to make an acquisition or buy back shares, and it's in a 50% drawdown, that's not going to be a good thing, right? So you need
Right.
to have a long enough horizon that you can kind of let that market math do its thing. So my sense is, and again, it's going to be different for everyone. Everyone's situation is different. But if you're solving for a loss of purchasing power, and normally you would buy gold, and now you want to buy digital gold,
Right. That
that's one specific solution. But even there, the answer depends on what else you have in your portfolio. If you own a
always.
bunch of real estate, um, then that's a real asset as well. And in this environment, if you bought it with a 30-year fixed rate mortgage, you're even better off because you're
Free.
locking in
Free land.
you're locking in that negative rate on the other side of the ledger, right? And so it's always subject to how your whole portfolio looks. But it certainly has its place. But it's, like I said, it's highly price inelastic, and it is subject to these boom bust kind of, occurrences. And but maybe dollar cost averaging is the way to
Yeah.
go.
I mean, if you were 5% Bitcoin and that was your conservative view as to what was appropriate, and it went up 20 times for you, it becomes a much larger part of your portfolio. The problem for most, I think, adamant believers is that they're not going to rebalance that. You talk about the importance of rebalancing, but they're not going to rebalance that.
No, no, and I think for the real hardcore, and I've met some of them. I go to Burning Man, and there's a lot of crypto stuff at Burning Man. It's like, I don't trust my money in fiat, so I'm putting everything in Bitcoin. And it's I wouldn't call it a religious belief, but it's not the traditional asset allocation approach. It's just that they think that fiat is more risky than Bitcoin, and I don't subscribe to that. I think if we
Right.
weren't the reserve, if we were living in Venezuela, maybe,
Sure,
but not
sure.
not not in the U.S. But there is that thinking out there.
Yeah, that's a bet on conviction, 100%. It's just, yeah, like you
Yeah.
said, it's in a belief system. I wouldn't call it a religion either, but I guess it's fair to say that it's close. So, what advice would you give to a college student that's trying to start a very basic portfolio and plan, starting to think about long-term gains and retirement? It's funny, Gary Gensler just put out a video for college kids actually saying, just save 8%, save $5 a week and you'll make 8%, which I have no idea where you're making 8% if you're just putting it in a bank account, which was the implication, but that's a different story. And you'll have $135,000 when you retire. Of course, that $135,000 might just buy you a loaf of bread, depending on how things go. But if
Yeah.
you were talking to a college student at this point, you have $50 you can put away a week. How should you approach that?
Um, uh, no, it's a great question, and I have this conversation, or I had it with my 24-year-old daughter when she graduated, and the message is very simple: start as early as you can, because the compounding math requires time, right? Don't start when you're 50, because you're never going to be able to. I mean, you should if you haven't. I mean, it's better
Right.
better than
Always.
nothing. But the compounding math is just not going to work as well as when you start at 20 or 25. And put away as much as you can, get that match from your employer if you have one. And it's just, it's delayed consumption, right? You're foregoing consumption now if you have the luxury of doing it. Not everyone does, of course. They're living,
Sure.
paycheck to
Paycheck to
paycheck.
paycheck.
But if you can do it and you maximize that contribution from your employer, and you can start as soon as you get your first paycheck, and you can invest it tax deferred, and you do that for 40 years, time and market history is on your side. And at Fidelity, we have target date funds where we kind of do the allocation for you, but you can do it yourself. You start you look at the time frame. Again, you look at that efficient frontier, and the price to be paid for the higher return is volatility. But if you don't need to buy a house in 2 years, and you have a long window of time, you don't really have to worry too much about volatility. I mean, obviously, if you need a down payment on your house in 5 years, you need to put that money in a different kind of portfolio. But if you're young and you have a job and you have an employer who matches who matches contributions, then the earlier you start, the more thankful you will be at the other side that you did.
So early often, and then the hardest caveat being you can't take it out every time you want to go on a trip.
No,
that was my problem. My problem was I was a very good investor until I wanted to go somewhere and I cash out a mutual fund that was supposed to be for my retirement to pay for the trip.
Exactly. And the nice thing about 401ks is that you don't really see the money leave, right? It kind of just goes off. And it's much easier to save that way than to make that conscious decision. Oh my God, $300. I could do this with that. Like you don't even think about it that way. So it's good.
Yeah, if it's money that never entered your account, that it's much easier to see go away and build. Before we're done, what plans does Fidelity have in the future for expanding crypto services? As you said, obviously, I mean, you guys are mining. You're really down in the trenches on this. So I have to imagine that, assuming the asset class continues to mature, that you have bigger plans.
Yeah, so we have a unit called Fidelity Digital Assets, or FDAS, and it's growing very, very quickly. We are obviously building out the infrastructure. We already have services for accredited institutions or accredited investors, in terms of storing Bitcoin, even buying it. And I'm not sure exactly what they're doing at this moment. I work for the asset management side, so it's a different arm. But they're fast growing and working hard at obviously building out the ability to serve an ever growing customer base, both on the institution side as well as on the individual side. And so, I think we committed early to being a big part of this. And from everything that I'm seeing is we will continue to do exactly that.
It's admirable and we appreciate it. You guys are absolutely leading the charge. And I think that we talked about institutional adoption in 2016 and 17, but that was kind of a joke. And now it might really be happening. And we definitely appreciate your efforts. Where can everybody follow you after this and keep up with what you're doing?
On Twitter, I'm at Timmer Fidelity. And on LinkedIn, you can just plug in my name and you'll see it. But for Timmer, it's at Timmer Fidelity. So
perfect. Well, thank you so much for taking the time. Much appreciated, and a lot of valuable insight for our listeners. I'm sure they're going to love it.
Great. Well, thank you, Scott, for doing this. Appreciate it.